Hi folks, David Waring here again with InformedTrades.com and today's lesson of the day. In our last lesson we looked at people's inability to deal with losses as a major reason why most people lose money trading. In today's lesson we're going to build on this concept by looking at two of the most common mistakes that even the smartest of people make when entering into trading so that we can hopefully avoid those mistakes on our path to becoming a successful trader. So let's get started.
Okay, so one of the most common mistakes that I see traders make is sticking in a trade where they know they're right in their analysis, but the market continues to move against them. As the famous economist John Maynard Keynes once said, the markets can remain irrational longer than you can remain solvent. Perhaps the best example of this are those who shorted the NASDAQ into the run-up in '99 and early 2000. At the time, it was pretty obvious from a value standpoint that NASDAQ stocks were way overvalued and that people's expectations for growth that they were buying on were also way out of line with reality. There were many great traders at the time who recognized this and began shorting the NASDAQ up into the peak of 2000. And as you can see here, those that did and remained with their positions would have had to have a pretty hefty account balance to have lasted up to the point where the market eventually did turn. So were these traders wrong? No, they weren't, because the market did eventually turn around and return back to rational levels and hasn't actually approached anywhere near 5,000 in the 8 years since. But many of those traders are no longer around because they just couldn't believe or just couldn't suck it up and get out of the market and move on because they were so sure that they were right in their analysis. And they were, but the market will turn in its own time, so to speak. The second biggest mistake that I see traders make is when playing different types of strategies and missing out on opportunities for profit, they're going to alter their strategy prematurely to try and avoid a missed opportunity in the future and get into a bad situation there. And one of the most common places where I've seen this is traders looking to play bounces off support or resistance or range or whatever it may be that's like that. And here's an example. So basically here's a chart of the Qs here, the NASDAQ ETF, and you see the first bounce here. You see the second bounce, which sets up our support line, and the trade on the next bounce. And you can see here what often happens around these support and resistance levels is the market will spike through that level and take out stops and then turn back around. And that's what happened in our theoretical situation here, as the trader got into a trade, was quickly stopped out, and then the market quickly returned in his favor where he would have made money. Now, to add salt to the wounds here, as a lot of people play these support and resistance levels, a lot of times the market will turn around just at the point where your stop was hit. So you get into a situation where if you had another tenth of a point or whatever, then you would have still been in the trade. And so what a lot of times happens, and it may not be after one trade like this, it may be after two or three, but a trader will get frustrated, and because he doesn't want to miss out on the next opportunity, he won't put his stop in. He'll say he's going to manage the trade, and then he ends up in a situation where the market breaks through the support level. He doesn't have his stop in, and he ends up in a situation where he's down significantly on a trade. Now, a lot of times what happens in this situation, because the trader's down so much, he doesn't want to exit the position, and he sticks with the trade hoping that the market's going to come back so he can get out and at least gain back some of his losses. And in a worst case scenario, a lot of times what traders will do here is actually add to the position to bring their break-even level down a bit, so they'll have a better chance of what they think is a better chance of getting back to break-even. And now sometimes the trader is going to get lucky and the market will turn around and he'll escape devastation to his account in this situation, but eventually, I promise you, or I assure you, that traders who practice these types of things will eventually blow their account out, and I've seen it time and time again. Okay, so the purpose of the InformedTrades.com community is to hopefully form a community of traders who want to come together and learn without all the hype that's associated with most trading education. So if you haven't done so already, I encourage you not only to visit the InformedTrades.com site, but to every page on the site has a comment section, so I encourage you to actively participate by leaving your comments and questions where appropriate. Okay, so that's our lesson for today. In our next lesson, we're going to look at another major part of trading psychology, which is related to not wanting to take losses, which is people's desire to follow the crowd. Okay, so we hope to see you in that lesson. As always, if you have any questions or comments, please feel free to leave them in the comments section below. And good luck with your trading.